You find a business you want to buy. The asking price is $850,000. You run the numbers, assume a conventional bank loan is out of reach, and figure you would need most of that in cash before anyone would take you seriously. So you walk away before ever learning that this is exactly the kind of deal an SBA loan was built for. Most buyers never get past that assumption. They think SBA loans are some kind of government grant program, or they assume the approval process is so complicated it is only for people who already know someone at the right bank. Neither is true. And the buyers who figure that out early have access to deals the others never consider. There is one thing that drives how a 7A loan gets approved, and it is not the value of the business's assets. It is whether the business can pay back the debt from its own cash flow. That shift in thinking changes everything about how you evaluate a deal. We are going to walk through the 4 parts of an SBA 7A deal so you understand how the approval actually works, why it is structured the way it is, and what it means for the deal you might be looking at. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Here is what most people get wrong before they ever talk to a lender. They look at a business listed for $900,000 and ask, do I have the assets or collateral to back a loan that size? That is the wrong question. A conventional bank loan on an asset-light business, a service company, a landscaping operation, a small manufacturer without much hard collateral is difficult to get because the lender carries the full risk. If the collateral does not cover the loan balance, the bank typically passes. That is not a judgment about the buyer. It is a risk math problem. The SBA 7A program exists to change that math. It does not eliminate risk, but it redistributes it in a way that lets lenders approve deals they otherwise would not touch. The 4 parts of an SBA 7A deal. The business pays for itself. The bank takes the first risk. The SBA provides the safety net. The money can go almost anywhere in the business. Part 1. The business pays for itself. This is the core of the entire approval process. When a lender underwrites a 7A acquisition loan, the first question is not what the business owns. The first question is what the business earns, and whether those earnings are enough to cover the loan payment with room left over. Take the landscaping company, purchase price of $900,000, SBA loan of $810,000 with a 10% down payment of $90,000. The seller's discretionary earnings, the cash the business generates before the owner pays themselves, are $320,000 per year. Annual debt service on that loan runs roughly $115,000. That leaves approximately $205,000 remaining after the payment is made. That ratio, cash flow relative to debt payment, is what lenders are measuring. For 7A, small loans, SBA guidance sets a minimum coverage ratio of 1.10 to 1, and a buyer who can make a credible case for projected improvement can sometimes qualify on forward-looking numbers rather than historical ones alone. For larger acquisition loans, lenders commonly apply their own internal thresholds above that level. The specific target varies by lender and deal, but the principle is consistent. The business has to demonstrate it can service the debt from operations. One thing worth being clear about, the $205,000 remaining is not all take-home. The new owner still needs to normalize their own salary, account for equipment replacement, and maintain working capital. The cash flow number that matters to the lender is adjusted, not raw. And this example is a strong deal by design. It is here to show the mechanism clearly. Many acquisition deals are tighter. Part 2. The bank takes the first risk. This is the part that surprises most people. An SBA loan is not a loan from the government. It is a loan from a bank or an SBA-approved lender. The lender writes the check, the lender services the loan, and the lender has real money at risk throughout the life of the deal. The SBA does not hand you funds directly. It guarantees a portion of what the lender is owed if the loan goes into default. That distinction matters because it explains why the lender still cares about your credit, your experience, and your financial profile. The lender carries meaningful exposure, even with the guarantee in place. The borrower is still personally obligated, collateral is still evaluated, and the bank still pursues collection if the loan goes bad. The SBA guarantee reduces the lender's net loss in a default scenario. It does not make the bank passive or indifferent to how the loan performs. Part 3. The SBA provides the safety net. When a lender approves a 7 loan, the SBA guarantees a portion of that balance. On standard 7A loans, that guarantee can cover up to 85% on smaller loans and 75% on larger ones, up to the $5 million program maximum. What that means is the lender is no longer carrying the full downside of the deal. If the loan defaults, the SBA covers its guaranteed share of the loss after required recovery efforts are exhausted. That guarantee is what allows lenders to approve longer repayment terms, lower down payments, and deals on businesses that do not have enough hard collateral to support a conventional loan. The flexibility comes from the risk redistribution, not from looser underwriting. The lender is still doing real credit analysis. The guarantee changes the math on what that analysis can support. Part 4. The money can go almost anywhere in the business. The 7A program is not a single-purpose product. One loan can cover a business acquisition, fund working capital, finance equipment, and in certain circumstances, roll in the refinancing of existing debt. SBA eligibility rules apply. Not every use of proceeds qualifies on every deal, and lender appetite varies. But the range of eligible purposes is wide, and a well-structured loan can address the full picture of what an acquisition actually requires, not just the purchase price on the listing. That flexibility matters because buying a business is rarely a clean single transaction. There are transition costs, working capital needs, and frequently equipment or infrastructure that needs immediate attention. A buyer who understands what the loan can cover is in a meaningfully different position than one who assumes it only applies to the headline number. One more point that belongs here: the lender evaluates the buyer, not just the deal. Relevant experience in the industry or in managing a business of similar size, personal credit, and liquidity all factor into the decision. The deal has to work financially and the buyer has to be credible to run it. Both conditions matter. Here are the key takeaways. SBA 7A. Loans are bank loans, not government disbursements. The SBA guarantees a portion of the lender's exposure. It does not write the check, and the borrower is still fully obligated. Cash flow drives approval. The question is whether the business generates enough adjusted earnings to cover the debt payment with room to spare. Collateral supports the structure but does not decide it. On acquisition loans, cash flow moves an application forward. Assets and personal guarantees are part of the picture, not the center of it. Coverage thresholds are real but not uniform. The SBA sets program-specific minimums, and lenders frequently apply stricter internal targets on acquisition deals. Know your numbers before the conversation starts. The program covers more than the purchase price. Working capital, equipment, and in some cases existing debt can be structured into a single loan within SBA eligibility rules. The 7A program exists because cash flow businesses with limited hard collateral are exactly the deals most conventional lenders cannot finance on their own. The guarantee changes the math, and that changed math is what puts a $900,000 acquisition within reach of a buyer who has $90,000 and a credible plan. If this helped you understand how the approval side of an acquisition actually works, subscribe. The next video covers why these applications get rejected, and most of the reasons have nothing to do with credit score. Research the deal before you fund the deal.